This is not financial advice, educational content only. If you asked most investors to rank bond markets by size, municipal bonds would probably not come up first. Muni market carries roughly $4 trillion in outstanding debt, more than the entire corporate high-yield market, and it has a structural feature that makes it unlike every other major fixed income market. It is owned predominantly by individual households, not because retail investors are sophisticated enough to pick through hundreds of thousands of individual issues, because the market was built around a tax exemption that only matters if you have a taxable income. That design choice cascades into almost everything else about how munis trade, how they're priced, and how they fail when they fail. Federal law exempts interest income on most municipal bonds from federal income tax. Many states also exempt their own bonds from state income tax. That sounds simple, but the consequence is a market sorted by tax bracket. A household in the top federal marginal rate, 37% as of the current tax code, would need a taxable bond yielding roughly 6.3% to equal the after-tax value of a muni yielding 4%. The math is basic muni yield divided by 1 minus your marginal rate. At lower brackets the advantage shrinks, and for investors in tax-advantaged accounts, 401ks, IRAs, pension funds, university endowments, it vanishes entirely. Pension funds, insurance company general accounts managing annuity reserves, and sovereign wealth funds have no particular reason to accept the lower pre-tax yield that munis offer. They buy treasuries or corporates where the pre-tax yield and the after-tax yield are the same thing. This isn't market failure, it's by design. The tax exemption was structured to give state and local governments a lower cost of capital by pulling in the investor base with the highest marginal rates, upper-income households. And it worked. According to the Federal Reserve's 0.1 financial accounts of the United States, households, directly and through mutual funds, have consistently held the large majority of outstanding municipal debt. That's my read of the data. The Federal Reserve's 0.1 release, the Financial Accounts of the United States, published quarterly, tracks who holds what in each major asset class. For munis, the data has shown a relatively stable pattern across decades. Households are the dominant direct holders, and when you include mutual funds and closed-end bond funds that are themselves primarily retail vehicles, the combined retail-facing share remains the majority. The Tax Reform Act of 1986 is worth flagging here. Certain tax-exempt muni structures had been used by financial institutions in ways that captured arbitrage between tax-exempt borrowing and taxable reinvestment. The 1986 reform closed most of those structures. It didn't eliminate institutional participation, but it reduced the incentive for banks to hold munis primarily for tax engineering rather than yield. The market became more clearly retail-oriented after that reform. The Build America Bonds program, created under the American Recovery and Reinvestment Act of 2009 and allowed to expire in 2010, ran a brief real-world experiment. BABs were taxable muni bonds where the federal government subsidized a portion of the interest cost directly to the issuer. Because they were taxable, pension funds and foreign investors could hold them without sacrificing pre-tax yield. Institutional participation in that program was meaningfully higher than in the standard tax-exempt market. When the program expired, that participation evaporated. The experiment showed that the retail dominance of the muni market is not inevitable. It's contingent on the tax structure. That's my read of what those years demonstrated. The U.S. Treasury market, for comparison, has a few hundred distinct securities, a handful of benchmarks at each maturity point. The most on-the-run notes trade billions of dollars in volume daily on electronic platforms with deep two-sided markets and tight bid-ask spreads. The muni market has over 1 million distinct UCITS outstanding. A QSIP is the identifier for a single bond issue. States, counties, cities, school districts, water districts, transit authorities, public university systems. Each issuer creates its own bonds, often with multiple maturities and structures within a single deal. The result is extreme fragmentation. Most individual muni bonds trade infrequently. A small-town water district revenue bond may trade once or twice a year, if that. Price discovery depends on brokers knowing who holds which bonds and negotiating through an electronic quote system or directly. The Municipal Securities Rulemaking Board, the MSRB, operates EMMA, the Electronic Municipal Market Access System, which since the mid-2000s has made trade reports publicly available. That improved transparency meaningfully. But it did not create a centralized exchange. Research by Harris and Piwowar, published in the Journal of Finance in 2006, documented that retail Muni investors paid systematically higher transaction costs than institutional investors for equivalent bonds. The mechanism was straightforward, with no central exchange and limited pre-trade price transparency. A retail investor buying or selling a single bond has essentially no way to verify whether the price they're getting is competitive. That's my read of what that research showed. When someone calculates a tax equivalent yield for a Muni bond, they typically divide the Muni yield by 1 minus their marginal rate. That arithmetic tells you whether the Muni yields more or less than a comparable taxable bond on an after-tax basis. What it does not capture is the liquidity premium embedded in Muni prices, or more precisely, the liquidity cost the holder is implicitly accepting. Illiquid bonds should, in theory, trade at higher yields to compensate investors for the difficulty of selling before maturity. In the Muni market, the retail ownership structure complicates this pricing. Most Muni holders are buy and hold investors who purchased for the income stream and plan to hold to maturity. For that investor, secondary market liquidity is largely irrelevant. They never intend to sell. The yield they care about is the yield to maturity at purchase. The problem surfaces when circumstances force selling. Retail investors in Muni mutual funds or ETFs can redeem on demand. When rates rise sharply or credit conditions tighten, funds face redemption pressure. The fund managers must sell bonds into a market where the natural buyer, the long-term individual investor, is not actively looking to add duration in that moment. Price impact can be sharper and faster than the theoretical liquidity discount suggests. The March 2020 period, when broad markets dislocated, demonstrated this mechanism. Muni funds experienced significant outflows, spreads widened rapidly. The Federal Reserve ultimately included Munis in its emergency lending facilities, an acknowledgement that the retail-dominated ownership structure had created a liquidity vulnerability the market could not self-clear quickly. That's my read of what that episode revealed. A few structural limits follow directly from the retail ownership model. First, the tax exemption has no value in a tax-advantaged account. If Muni bonds are held in an IRA or a 40-1, the holder is accepting a lower pre-tax yield without receiving the tax benefit that justifies it. The market is designed for taxable accounts. Munis in retirement accounts are generally a structural mismatch. That's my read. Second, the market is policy dependent in a way that corporate and Treasury markets are not. If the federal tax exemption for municipal interest were significantly curtailed, a proposal that resurfaces periodically in tax reform discussions, the ownership base would need to reprice. Without the high-bracket retail buyer, Munis would need to offer higher pre-tax yields to attract institutional capital. That repricing would hit existing holders directly and raise borrowing costs for state and local governments. This policy risk is embedded in every Muni position today. It is not consistently reflected in yield spreads. Third, fragmented ownership makes credit deterioration harder to detect in real time. In the Treasury or corporate markets, price discovery is continuous. A deteriorating credit reprices quickly in secondary trading. In the Muni market, a struggling small issuer, a municipality with an eroding tax base, for instance, may not see its bonds reprice for months if those bonds are simply not trading. Existing holders don't have a reliable mark. The early warning mechanism that liquid markets provide is largely absent here. The retail-dominated ownership structure of the Muni market is a policy feature, not an accident or oversight. The federal tax exemption was designed to lower the cost of state and local government borrowing by recruiting the investor with the highest marginal tax rate, the upper-income household who values tax-exempt income. That mechanism functions. State and local governments borrow at yields structurally below comparable maturity corporate bonds, adjusted for the relevant tax treatment. The cost of that design is liquidity and transparency. The market is fragmented, expensive to trade for individual investors, and opaque relative to every other major fixed income market. Most of the time this doesn't matter because most retail holders never sell. But the structure is fragile in stress scenarios. In a specific way, the natural buyer disappears precisely when it is most needed. The common framing that Muni market illiquidity is priced in and therefore fine is worth questioning. Liquidity risk is notoriously difficult to price accurately before a stress event because it is invisible until it isn't. The Harris Piwowar transaction cost data suggests retail investors have not historically been compensated for the structural disadvantage they face in OTC price discovery. The March 2020 episode suggests the broader market can experience rapid, non-linear price dislocations when the retail bid disappears at scale. These are structural features of the market's ownership model, not idiosyncratic noise. That's my read. This isn't advice, it's a way of looking. Here's a real tool. The MSRB's EMMA system publishes all Muni trade reports at emma-musurb.org for any bond you hold or are evaluating. You can check how frequently it has actually traded and what those trades cleared at. Thin recent trade history is concrete evidence of the liquidity risk this video described. Separately, the ICI publishes weekly Muni fund flow data during rate move cycles. Watch for accelerating outflows as a leading indicator of forced selling pressure. I'm Diane, back next briefing.